Hi, I'm Max Keiser. Welcome to the Keiser Report. You know, the problem with China starting a currency war is that a half an hour later, you want to start another one. Stacey Herbert, all kidding aside, what's going on there?
Max Keiser, yes, that's a train down there coming into Penn Station. But, you know, there are currency wars. That's the biggest story that we've been covering here on the Keiser Report for the past 3 or 4 years. And China has been very vocal, speaking out against the currency war. Why China fears currency wars. On Friday, Commerce Minister Chen Deming was the latest to raise concerns about competitive currency depreciation and the effects of excessive money printing by central banks. The head of China's sovereign wealth fund was less diplomatic, reportedly warning Japan against treating your neighbors as your garbage bin and starting a currency war.
Right. What I thought, according to Christine Lagarde, everybody was on the same page with this global currency war, that they were all devaluing together, and that there wasn't a currency war, it was a currency worry. It doesn't sound like that's playing out in the Pacific currency war theater. One
would think they were, you know, through the past of this currency war on China's behalf, they've been very concerned about America and their money printing and quantitative easing. But it's moved down to Japan. Their concern primarily now is about Japan, because since the middle of last November, the yen has fallen by close to 18% against the dollar. This is likely to prompt capital flows into hard currency. So in the Asia region, Max, the yuan is considered hard currency relative to the yen. So all of this capital inflows are going into China, causing inflation, causing more property speculation.
Right. Well, Bank of Japan has been essentially nationalized by the new government in Japan, and they've been told to print money wildly, recklessly out of control. Meanwhile, Mark Carney's being moved from the Bank of Canada over to the Bank of England. His mandate, like Japan, is to print money out of control. Ben Bernanke is already printing money out of control. The European Central Bank, the ECB, is less inclined to go down the path of this type of reckless money printing. So that's why the euro, relatively speaking, has not experienced the kind of damage that some have predicted, with the peripheral nations like Greece and others running into so much trouble. But at some point, the ECB will join in, and they will also be forced to print like madmen, and the ECB's balance sheet will increase by trillions of euros. And this is the 21st century conundrum that we all face, is that there are no underlying strong economies from the point of view of manufacturing, wages, and savings. There's only financialization and financial trickery, which is fueled by 0% interest rates and money printing, which, as Jim Rickards would tell you, is leading to gold $10,000 an ounce.
So back to China, as I said, they're being considered like the hard currency of the Pacific region. And the latest figures showed a surge of money heading into China. Last week, China's central bank reported that companies and individuals changed 684 billion yuan, or $109 billion worth of foreign currency in January. This was a record for a single month, and the data point is often used as a proxy for hot money flows.
And that's really the only game left in town, is to try to manage the hot money that's out there. Remember, the global GDP is approximately 60 trillion, but the global shadow banking system is quite a bit larger, probably close to 120 to 150 trillion dollars. The global derivatives market is 700 trillion dollars, and really that on the margins of the shadow banking system is where the fortunes of these underlying economies are going to be determined. So it has absolutely nothing to do with house prices or wages or jobs or savings. It has everything to do with people fighting the currency war in the shadows. And we only see the vestiges of the shooting that's going on when occasionally you'll see a flash crash or a gap opening or some kind of market event. But behind the scenes, it's a raging stew of quantitative, nightmarish currency bubbles.
So now they're concerned mostly about capital crossing their borders, plunging itself into their economy, and them losing control of their own monetary policy. And we've also seen this in Switzerland, where Switzerland, of course, is the safe haven. It's considered a safe haven. They saw massive inflows of capital during the crisis, and they introduced a currency peg. Now, of course, China has a currency peg to the dollar, but they say perhaps the real reason behind the amplified currency war rhetoric is that China has been pushed into a tight spot. the end game could be floating its currency much sooner than it would have wanted.
Right. Well, you know, this is the, I would call it the Peter Schiff outcome, where the Chinese currency appreciates, and you have a tremendous local domestic economy of spenders in China who are buying the things that they've been manufacturing because they can afford it because their currency is suddenly appreciated. Remember, the US dollar as a percentage of world trade has steadily decreased every quarter of every year for the past 20 years. And this trend is now getting to the point where, as a percentage of global trade, the US dollar will dip below 50%. At that point, you can categorically state that the US dollar is no longer the world reserve currency, and we're rapidly approaching that key number.
So again, here we see a situation where China might have to internationalize its currency, like let it float suddenly. Okay, that's one thing. So in the background, that would mean they must be looking at a way to accumulate gold more rapidly if they think that's the situation. But on the international stage, look at this next headline. Currency wars, central banks in denial or lying. And this is from our friend of PonziPlanet.com, Mitch Firestein. And he says a large consumer products company, Johnson & Johnson, announced a one-off loss owing to a 32% devaluation in Venezuela. Now, this cost them $100 million. So he says, think about that. Think about a company the size of Johnson & Johnson losing $100 million on a little tiny country like Venezuela devaluing by 32%. Now, what happens if the yen has a sudden devaluation or the yuan a sudden upvaluation to these sort of companies? And this is just one company on one currency transaction.
Right. You know, Apple's got billions and billions held offshore that they have not yet repatriated onto the U.S. And all these big multinational companies play these Forex games where they're moving money around in the shadow banking system. And it's a point well taken, because the Fortune 500 companies out there, very little of what they do is what you think they do. Johnson & Johnson mostly is a financial speculator. The banks obviously are financial speculators. The oil and gas companies are financial speculators. That's their primary business, is by hoarding cash on their balance sheet they get almost for free from the central banks, and then playing accounting games and market manipulation games and currency arbitrage games, and then they pay themselves these humongous bonuses based on gaming the system. Johnson & Johnson, I mean, they're not about baby powder and baby oil. They're about gaming the system. They're about financial terrorism. They're about manipulating the system. They're about political influence peddling. They're not about babies.
So again, Mitch Firestein notes this, that in recent months, the Japanese yen has plummeted 30% against the euro and some 20% against the US dollar. Those figures are astounding enough in themselves. But get this, the euro currency probably won't even exist in a few years' time. Now, I know you and Jim Rickards disagree with that, but he's noting that in Italy, Beppe Grillo, he says he would get rid of the euro. We would exit the euro. Now, even in Germany, they're having like a surge in the anti-euro parties. So there is a chance that, not that it would collapse on its own, but that the people would choose to remove their economies from the euro.
Well, let me make a statement, and I'm not saying this for the sole reason of being provocative, but it is a provocative statement that I think needs to be said. If you read, let's say, John Perkins' Confessions of an Economic Hitman, anytime you have a populist leader, like they have potentially in Italy, they suddenly find themselves falling out of an airplane at 30,000 feet or meeting some other similar mishap. There's no way that this guy is going to get anywhere near running that country before some major accident befalls him.
And before any major accident befalls the global currency grid, of course, we have to keep an update on this next headline, and that is about gold. Korea joins Russia, Kazakhstan, and boosting gold holdings. The Bank of Korea added 20 metric tons in February, raising its gold reserves by 24% to 104.4 tons. Holdings rose about 1.03 billion by value to 4.79 billion at the end of last month, equivalent to 1.5% of total foreign exchange holdings. This follows on them. They added 30 tons in 2012 and 40 tons in 2011. So they're rapidly accumulating. They're in the midst of that whole Japanese versus China currency war going on.
Well, Korea, like, it's a middle-sized central bank. Okay, they see what the big central banks are doing. They're starting to aggressively buy gold, as we've been saying on this show. Russia, huge gold buyer. China, huge gold miner and buyer, and they're out there around the world accumulating gold on the stealth. to increase their position. The central banks know that the game being played of a circular firing squad, otherwise known as quantitative easing happening around the world with central banks debasing their own currency, can only end in one possible outcome, and that is with gold at $10,000 an ounce. So they don't want to be left at the altar of the new global currency grid holding nothing but a bunch of ramen noodles in their hand. They want gold.
And so finally, Max, as we talk about this quantitative easing, about the possibility of the euro falling apart, what if it's all because of just a typo? And I want to look at this quick final headline here from the United States about what a typo does to a human and what it could possibly have done to our global economies. Another person dies from the stress of dealing with Wells Fargo. On the morning of December 19th, 2012, in a Torrance courtroom, Larry DeLaSousis, her heart stopped as he watched his attorney argue his negligence and discrimination case against banking behemoth Wells Fargo. The bank's typo led Wells Fargo to demand that DeLaSousis pay $13,361.90, 2 years of late property taxes the bank said it had paid on his behalf in order to keep his Wells Fargo mortgage afloat. Well, in fact, Max, he didn't owe those taxes. That didn't stop them from collecting it, doubling his mortgage payments. He was on a fixed income because he was retired, and he ended up losing his house, his wealth, everything on a typo.
Well, it reminds me of a key plot point in the movie Brazil, Terry Gilliam's Brazil, where due to a typo, there was the state went after an individual, and then the Robert De Niro character, who's kind of operating in the elevator shafts of this dystopian nightmare, is out there pulling a stunt where he would go into a home and he would reverse the sewage pipe with the air pipe so that the apartment was flooded with sewage. Now, I suggest that down there in Omaha, Nebraska, headquarters of Warren Buffett's Berkshire Hathaway and Charlie Munger, the biggest shareholder of Wells Fargo, somebody reversed the pipes with the oxygen in the sewage. Because as the major shareholder of Wells Fargo, have they come out and made any statement? Or is Charlie Munger going to make one of his comments where he goes, well, too bad you killed yourself and your family because of a typo. Suck it up! Suck it up! All right, Stacey Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away, much more coming away, so stay right there. Welcome back to the Keiser Report. I'm Max Keiser. Time now to bring in Jim Rickards, author of the internationally acclaimed Currency Wars. Jim Rickards, welcome back to the Keiser Report.
Thank you, Max.
All right, you've become a globe-trotting spokesperson to try to educate the world about these currency wars with varied success. But one video I've seen on YouTube that's fascinating talks about a financial Pearl Harbor, and kind of an extension of what we read about in your book, which was the role-playing that goes on, war games going on. Talk about this financial Pearl Harbor a little bit.
Sure. The financial Pearl Harbor, as I call it, Max, that's a little bit more on the national security side, but definitely related to the currency wars. The way I would distinguish them is currency wars are an economic phenomenon. It's economic competition between countries. I want to steal some trade from you, so I cheapen my currency, the dollar, whatever it may be. I export my deflation to you. I try to get some inflation, steal some exports from you. That's a currency war. It's nasty, but it's economic. Financial war is a little different, which is actually you would use finance as a weapon. You would use stocks, bonds, derivatives, currencies as a weapon to try to destroy your enemy, the same way you would with a missile or an aircraft carrier, but you're using financial weapons. Now, there's separate sort of areas of study. I'm involved in both. But where they come together is you could have something that starts out as a currency war but gets nasty and then accidentally trips into a financial war, with much worse outcomes. Kind of like the old Dr. Strangelove movie where the two sides didn't want a nuclear war, but they got one by accident. So those kinds of things can happen.
Right, we have something of a financial doomsday machine in this global derivatives market that is highly leveraged and highly unstable. And now, a few years ago, when currency war was coming out, people were denying that it exists.
Right.
Now they all seem to agree that it exists, but that it doesn't matter. Talk a little bit about some of the rhetoric we see now.
The currency war became just too big and too obvious, particularly with the Bank of Japan move. We were talking about it years ago with the U.S. and Brazil and Switzerland and others, but finally the BOJ just said, we're going to trash the yen. So it became a little bit obvious, but people still don't like to talk about it in exactly those words. So you have Madame Lagarde, head of the IMF, saying, well, we don't have a currency war, we have currency worries. You have Barry Eichengreen, leading scholar of exchange rates, saying, well, it's not a currency war, it's a stimulus war. Well, my question for Barry will be, well, Barry, how do you get the stimulus? You get it by cheapening your currency. So it's still a currency war. We have Mario Draghi coming out saying, the less said about this, the better. It's an exact quote. So again, everyone's sort of, they're using euphemisms, but it's a currency war, plain and simple.
Isn't this a classic prisoner's dilemma situation? The Nash equilibrium, as it's called, they're all in the interrogation room, and they're all claiming they don't have responsibility.
Right.
But all it takes is for one dissenter, and you have a ripple effect, and then you have, I mean, you have to almost go back to World War I. It's kind of a similar lead-up. Massive globalization, coordinated, manipulation to some degree, and then it goes all haywire.
Well, that's exactly right. Now, up until 1971, we had a gold standard. It was flawed, but it was some kind of gold standard. From 1980 to 2010, we had the dollar standard. Not as good as the gold standard, but the U.S. said, we're going to maintain the value of the dollar, and all you other countries can peg to the dollar if you want. In 2010, President Obama, Ben Bernanke, and Tim Geithner tore up the dollar and started this new currency wars. So now you're exactly right. We have an unstable situation. When there's no leadership, and right now the United States is not providing leadership on the economic or the political front for that matter. When there's no leadership, it's every country for himself. So you see, Germany cozying up to Russia. You see Japan going their own way. You see China trying to build alliances. That's a very unstable situation. Where's the equilibrium? And you can have a dual or even triple equilibrium system where you get in a situation where one equilibrium breaks down and it jumps to another equilibrium. That's a well-known phenomenon in physics. But we could actually be in between. Like we're out of the old equilibrium, but we're not to what Bill Gross calls the new normal. We're not there yet. We're in that in-between stage, which is very turbulent, very uncertain.
All right, so you're talking about a quantum leap.
Yes.
From one equilibrium to another, and you're applying physics to finance, and this is typically not the way people look at it, but your way of thinking is you have to apply almost concepts like chaos theory and other quantum theoretical, because the amount of derivatives and the amount of leverage in the system is so great that you don't really have a classic supply and demand economy anymore. It's more of a systems analysis where you're just trying to figure out how these hundreds of trillions of dollars of derivatives are going to flow. And just like in quantum mechanics, depends on where you're looking, where you're sitting, what you see.
Well, that's exactly right, Max. But when I do this, to me, it's not a metaphor. I'm not like looking at the financial markets and thinking of physics and saying, well, metaphorically, this is a little bit like that. I think it exactly applies. Now, the exact branch of science is called complexity theory. It's related to chaos theory. It's related to systems dynamics. It is a systems dynamic. Not every system is unstable. Some are stable, some are unstable. You can have a non-interventionist, relatively stable supply and demand system. We just don't have one right now. We have a very unstable state of affairs. But when you look at complexity theory, you say, what are the hallmarks of complexity theory? Well, it's diversity in the players. We have that in capital markets. It's interaction. Well, we have that in capital markets. It's adaptability, which is sort of a learning function. And then it's communication between the parties. So we have all the elements of a complex system in capital markets. They are complex systems. And once you reach that conclusion, you can take 60 years of good science and apply it. It's extremely helpful in understanding what's going on.
So Nassim Taleb seems to be something of a frustrated philosopher. Jim, you seem to be a frustrated physicist.
Well, I'm not so frustrated, Max, because I've spent 10 years...
But is there a category of financial physics as such? I mean, you've kind of pioneered this in a way.
I've pioneered a little bit in terms of applying it to capital markets. There is a branch called econophysics, which is basically understanding the economy through physics. I prefer complexity theory because I think it's straight up. You can take complexity science, and it applies very well to capital markets, not metaphorically, but scientifically. The elements are there, the dynamics are there, and so it's a much better understanding. I'm a big fan of Taleb. I love what Taleb did in The Black Swan. He took a baseball bat and demolished the bell curve, once and for all. Someone needed to do that, and I'm glad he did. But he kind of stopped there. He said, well, models don't work, so let's just forget models. And he said, stuff happens. He was a little more colorful than that, but kind of stuff happens. Threw up his hands, walked away, and became a philosopher. I think we can do better. I think we can use science, but we have to be humble about what we can know, and we have to use it carefully.
All right, you mentioned this idea of financial warfare, and I want to digress a little bit and go back to look at Greece.
Sure.
Because some argue that Greece, the problem in Greece, the collapse in Greece, was part their own making, but part from outsiders, really using financial warfare, using credit default swaps, I remember one of the banks here on Wall Street, Goldman Sachs, they hid some debt to allow Greece to get into the euro,
Sure.
and then made bets against Greece later.
Right.
Then John Paulson made bets against Greece, the hedge fund manager, later.
Right.
Isn't that financial warfare? And shouldn't there be a way for a country like Greece to seek recourse in the case that they've been attacked in this way? Your thoughts?
The thing is, Max, there are multiple parties, so it's not just two sides, you know, the good guys and the bad guys, so to speak. I don't think Germany wants to destroy Greece. Germany wants to help Greece, but they're doing it in a very, you know, hard way.
Yeah, let me just cut in,
Sure.
because, you know, they're buying these assets now for pennies on the dollar in
Yeah.
Greece. The private equity funds. I was there when Steve Forbes was down there
Right.
shopping for assets, you know, when the tear gas was flying in the International Chamber of Commerce. So how much, my question is, isn't there a bit of a controlled demolition aspect to the way Greece fell?
I agree with that, Max, but I wouldn't lay it all at Germany's feet, because remember, John Paulson, you know, John Corzine when he bought bonds, others, you know, Forbes, the people you're talking about, they're not countries. They're individual actors. They might be hedge funds. They might be wealthy individuals.
I'm not placing it on Germany's feet. I'm saying that Greece was a $300 billion economy, which is on a leveraged buyout basis, not a big leveraged buyout.
Yeah.
And you had guys, predators, come in. You know, Germany was just looking at this from taking a step back. But you had guys go in there. They trashed that country. Now they seem to go from there. Then they went to Spain with a war chest. They're looking at Italy. To what degree is Europe being destabilized by rogue, predator, leverage guys from Wall Street in the city?
I think to a very great extent. This is just Wall Street as usual. This has been going on for 100 years, you know. They fleece individual investors in U.S. markets. You know, the banks, you know, fleece depositors by not paying normal interest rates. And derivatives traders fleece countries by, you know, feeding them all this stuff, leveraging them up, and then collapsing it and, you know, front-running them. So I definitely agree that's going on. But there's something else going on, which is Germany is trying to impose the German model on the periphery. It may work. It's hard. You know, you had, you know, Rubini and Stiglitz and Krugman and all these guys say, you know, Greece has got to quit the euro, cheapen the currency.
Okay,
It's not necessary.
I got to jump in here, Jim, because, you know, a few years ago when all this was kicking off, you and I were doing interviews in various TV shows around the world, and we used this phrase, Fourth Reich, to describe Germany. It was a bit provocative at the time. But how much of that is rhetorical and how much of that is real?
Well, Germany is the richest, most powerful country in Europe, so it's bound to dominate Europe. The same way the U.S. dominates North America, China's going to dominate Asia. That's a natural state of affairs. But when I say the Fourth Reich, I mean, it's not just to be provocative. I'm not thinking about the Third Reich, which is pretty despicable. I'm thinking about the First Reich of Charlemagne. And that was a much more, it's called a soft touch. It was cultural, it was educational. There was a military aspect to it as well. I don't think we'll see the military this time around. It'll be financial instead of military. But yeah, I think Germany is sort of destined to dominate Europe, and they're doing it in a way that's probably good for the rest of Europe. I think, you know, Greece can lower its unit labor costs. It doesn't have to go back to the drachma and cheapen the currency. Just lower your unit labor costs in euro terms, bring in Chinese capital, bring in German technology, utilize youth labor, and you'll be an export powerhouse. That's working.
Let's go back to the currency wars and kind of the main event, because in China, the deputy governor of the central bank said China is fully prepared for a looming currency war. I guess they just read your book. At the same time, Brazil surrendered and has stopped fighting the currency war. Talk about it.
Well, as a matter of fact, I just recently met the Chinese translator of my book. Actually wrote a new Chinese forward, and he told me, he's a very well-connected guy, he told me that the leadership actually have read currency wars, so I was very happy to hear that. But yeah, I think the Chinese are being honest. You know, Madame Lagarde is not, Mario Draghi is not, Ben Bernanke is not, but the Chinese call it like they say it is a currency war. Right now, they're on the receiving end. They've been on the receiving end of U.S. aggression. Now they're on the receiving end of Japanese aggression. They're getting a little tired of it, so, but they're ready to do what they have to do.
So those who don't think or buy the currency war story, they should look at what the central banks have been doing since 2009.
Correct.
Which is buying gold.
Right.
Which is, for the 40 years they were sellers, then they became buyers.
Right.
Now South Korea just bought a big chunk recently. Yep. Russia's been buying. Talk about how the central banks are adding to their positions.
Well, that's really smart. I mean, first of all, you know, gold is the one asset that won't vaporize if there is some kind of collapse, which I think it can't roll out. But what I've been saying, I was down in Australia last summer. I was speaking to officials in Korea recently. What I was saying to them is, look, if you think your currency is too expensive, I would say, look, embrace the strong currency, make yourself a magnet for investment. The way you generate exports is not with a cheap currency. You do it with innovation and value added. But I would say to the Koreans, if you really think your currency is too strong and you're worried about it, buy gold. Print money, buy gold. That way you'll find the FX rate, find the course rate you're comfortable with. Keep printing money until you hit that target, and you get to keep the gold. I mean, why buy bonds and why buy assets like that?
That's an excellent question. Why buy bonds? At what point will one of these central banks print money to buy gold instead of printing money to buy bonds.
Well, I think you're seeing it in Korea already. I think that's the coming thing, and I think the Chinese are doing it as well.
That could be the tipping point. Now the big number, we only have about 30 seconds left. Your big number to watch would be tons of gold owned by China. You think that when they come out, or they own 4,000 tons up from the 1,050, the official reserve number,
right,
then their gold to GDP number gives them a place at the table.
Correct.
To really, you know, say to America, we're now going to take a move and become dominant.
Right, or you, the United States, can't dictate to us. We're on an equal footing with you. China's not there yet. Interestingly, Russia is there. It's the gold gap. It's kind of like the old missile gap in the 1960s. Russia has closed the gap. China has not. They're catching up fast.
All right, Jim Rickards, thanks so much for being on the Keiser Report.
Thank you, Max.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank my guest, Jim Rickards, author of the phenomenally successful Currency Wars. If you want to send us an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.